Hello, student. I, Dr. Shafali Jain, Assistant Professor, Tirthankar Mahavi University. Student, tomorrow we discuss about the methods of measurement of national income, and in it we also discuss about the production method. And hope you well understood what is the production method. Today we discuss about the income method. First of all, we also briefly explain what is the national income. So, national income refers to the value of goods and services produced by a national produced by a nation during a particular finance year. Therefore, it is the net result of all economic activities that take place during a financial year and is valued in monetary terms. It includes payments made to various resources, either in form of rents, wages, interest, and profits. A country progress can be estimated by the growth of its national income. So, under this income method, national income is measured as a flow of factor incomes. There are generally four factors of production: labor, capital, and land, and entrepreneur. Labor gets wages and salaries. Capital gets interest. Land gets rent. And entrepreneurship gets profits as their remunerations. So, beside there are some self-employed person who employ their own labor and capital, such as doctor, advocate, CAs, etc. Their income is called mixed income. The sum total of all these factors incomes is called NDP, net domestic product at a factor cost. So gross gross net income is equal to gross national income is equal to rent plus wage plus interest plus profit plus income from abroad. So, in simple, the income method calculates the national income based on factor incomes, the incomes received by every resident of a country of the for the productive services produced by them during a year are added together to determine the national income of any economy. In other words, under the income method of calculating national income, all incomes of a country occurring uh, of the factors of production through rent, wages, profits, interests, etc., are added up together for the determination of national income. This method is also widely known as the factor payment method or distributive share method. The total of all income earned by factors of production within a domestic territory of a nation is known as domestic income. So, according to Hansen, net domestic income as the income generated from in the form of wages, rent, interest, and profit in the domestic territory of a country, while all producers, normal residents, and non-residents in an accounting year. So, the components of the factors income as a compensation of employees. COE, any compensation of employees, COE refers to the amount paid to employees directly or indirectly by the employers in exchange for their services. It includes all kinds of payment and benefits received by the employees directly or indirectly. COE COE means compensation of employees consists of three elements. First of all, wages and salaries in cash. It consists of all monetary benefits like salaries, wages, bonus, commission, dearness, allowance, etc. Wages and salaries in kind. It includes all non monetary benefits like health and education facilities, rent free accommodations, free car, etc. And imputed value of such benefits should be calculated in the national income and implies contribution to social securities scheme. It consists of the employer's contributions uh, to the employee security, for example, contribution in gratuity, provided fund, labor, welfare fund, etc. The main aim of these contribution is to ensure employee securities. And three, there are also three exemptions in the elements of COE. If an employee reimburses the business expenses incurred by him, it will be excluded from the compensation of employees. It is because these types of expenses are a part of the intermediate consumption of business enterprises, and wages and salaries in kind do not include any non monetary benefits, which is essential for work and in which there is no discretion on the part of employees. For example, as payments for uniforms worn by the employees during working hours are a part of the intermediate consumptions of business enterprises. And if a third party, say an insurance company, contributes to the social securities of an employee, it will not be included in COE. It is because the third party is not an employer of that employees. Besides, if an employee makes such a payment for himself, it will not be included as the employee in making the payment from COE only. So, wages and salary. This head are included all forms of wages and salary and through productive activities by workers and entrepreneurs. It includes a sum received for deposited during a year by way of all types of contributions like overtime, commission, provident fund, insurance, etc. Now, in the national income method, now we discuss about rent. Rent is the factor payments of the land. Total rent includes the rent of land, shop, house, factory, etc. And the estimated rent of all such assets are as used by the owners themselves. Rent is that part of the factor income that arises from ownership of a land and buildings. Rental income includes both actual rent obtained from the let out land and imputed rent obtained from self occupied land. The imputed rent of a self occupied house is calculated at the market value of that house. Royalty refers to the income of earned from granting, leasing rights for self-owned assets. For example, the mineral deposits, coal, natural gas, iron, etc. Owners can earn more through royalty by giving mining rights to the contractors. So, rent is the money you pay for a use of land. By calculating income, rent refer only to the income earned from using any land. Rent paid for the use of machineries and other equipment is not accounted for as rent. Now, in addition to rent, another form of the income is royalty. Royalty is the amount you pay to an individual or a company in exchange for the use of assets such as coal or gas. Now we discuss about the interest. Interest is the factor payment of capital. Interest refers to the income earned from the lending funds of production units. It includes both actual or imputed interest provided by entrepreneur. Interest income consists of the interest of on loans taken for productive services. It doesn't include interest paid by one firms to another, interest paid for loans by a consumers taken for consumption, and interest paid by government on public debt. So interest refers to the charges you pay for using borrowed capital. Now, this includes the interest paid when a company takes a loan for an investment. Similarly, when a family invests in a property or a house, they take a loan from a bank and pay an interest for the same while repaying the loan over a period of time. However, while calculating national income, economics consider only the interest paid by the production units. Now, in the now we discuss about the wages, salaries, interest, and rent. Now we discuss about the profits. Profit is the factor payment of the entrepreneur. Profit refers to the money that organizations make while producing goods and services. Now, companies distribute the profits they make by paying income tax to the government and dividends of shareholders. And the amount that is left over after paying tax and individual is called undistributed profit. So, profit is the income or reward of the entrepreneur for his contribution to manufacturing of goods and services. In other words, it is a real income that is entrepreneur earned after paying off all other factors of production. The profit earned is used for three purposes. Corporate tax. It is the tax paid by a firm to the government for the profits earned by them in a particular periods. It is also known as business tax or profit tax, just like a dividend in the part of profits given to shareholders in their shareholding ratio. It is known also as distributed profit. Next, retained earning. It is the part of the profit that is kept aside as a reserve to the handle the uncertain situations that may arise in a business. It is also known as reserve and surplus or undistributed profit or saving of private sector. Profit is equal to corporate tax plus dividend plus retained earning. Now we discuss about the income method. It is income generated by unique union corporated. So mixed income is generated by union cooperated enterprises such as small shopkeepers, retail traders, etc., and own account workers like farmers, warriors, etc., doctors, advocates. The term mixed income is used for any kind of income which has more than one kind of factor income. It arises from self employed workers productive services. The income of these workers includes profit, rent, wages, and interest and can not be separated from each other. For example, a tutor giving tuitions at his residence. And there are some reasons for the mixed income, as every organization uses different accounting practices while preparing its accounts, which makes it difficult for the national income estimators to identify the components of different factors of income. Besides, the estimators do not always have the accounts of every production unit. Therefore, they have to consider mixed income. Just like if the total factor payments can be estimated but cannot be classified into separate head, then an additional factor payment mixed income is added. This factor payment is also called mixed income or self-employed, as this situation mostly occurs in the case of self-employed people like consultant, chartered accountant, etc. So there are many steps of the income methods. The first step is to identify and classify factors of production of all the producing firms into primary, secondary, and tertiary sectors. So, so we will also take an example of the national income. As we also see, example is also written in your screen. The production of bread has three stages. First, the farmer produces the wheat and sell it to the flour mill. Second, the marifer turns it into the flour and sell it to the wickers. Third, the wicker makes bread and sell it to the final consumers. So the third, baker makes bread and sell it to the final customer and take final price of bread and take the value added at each successive stage of production. First stage show income of farmer. Second stage, the value added by the millers equal the sale of flour, less cost of wheat, and third stage the value added by bakers equal the sale price of bread less the value of flour. The value added of each stage can now be allocated to the various factors of production, the income of farmers. Manufacturer bakers represent their profits, wages of their employees, rent of land and buildings, interest on capital employed. So, measurement of national income by income method, net income, net national income is equal to employees compensations plus operating surplus. Operating surplus है wages, rent, profit, and and interest. Net income plus net factor income from abroad. Sorry, I stand for mixed income. W wages. W stand for wages and salaries. R stand for income from rental resources. P stand for profit and I stand for mixed income. So the income methods of national income calculated to use of the distribution level. The national income is estimated using this method as a flow of factors incomes. Labor, capital, land, and entrepreneurship are the four important production components. Labor is the compensated with wages and salaries. Capital is the compensated with interest. The land is compensated with rent, and entrepreneurship is compensated with profit. Moreover, certain self-employed individuals, such as doctor, lawyers, and accountant, use their land and capital. The earning of such people are called as a mixed income. The net domestic product (NDP) as a uh, NDP at factor cost is sum of these factor income. So national income using the income method in is calculated as total wages and salaries received as a 25, 25, oh sorry, 25,000 is 2 lakh 55,650. Total interest and dividend received 10,000, and total rent and imputed rent is 80,880, just like a gross domestic product from the companies 65,500, total income of self-employed 33,700, just like a income paid account 54,345, income received from abroad 76,680, and capital consumption 445. So there are many steps of income method. The first step is to identify the, and classify the factors of production and factor of production of all the producing firms into primary, secondary, and tertiary sectors. Just like the second step uh, of calculating national income through the income method is the estimation of the factor income paid by each factor. The factor income paid by various sectors are grouped under the heads compensations of employees, rent and royalty, profit, interest, and mixed income, etc. Third step, the next step is to calculate domestic income (NDP) at a factor cost. The total of the all factors income is known as domestic income (NDP) factor cost. NDP factor cost is equal to compensation of employees, as I have also discussed it, plus profit, plus rent and royalty, and plus interest, and plus mixed income. And third and last step, the last step of calculating national income through the income method is the estimation of net income from abroad, yani NFIA, net factor income from abroad. NEIA is added to domestic income and DP factor cost to get the national income NNP factor cost. So NNP factor cost is equal to NDP factor cost plus NFIA. But there should be some precaution also have to calculate to measure the national income with income method. First off, transfer income will not be calculated included. Transfer income such as donations, charity, scholarships, old age pension, etc., are not counted in the national income as these activities are not connected to any production activity and no value addition takes place. And next, as income from sale of second-hand goods will not be included. Income received from the sale of second-hand goods, also known as the capital gains, is not calculated in national income as their original sale has already been included at the time of purchase. If these goods are calculated again, then it will lead to the problem of double counting. However, any kind of commissions or proceeds received by agents on the sale of these goods will be included as it is an income received for rendering productive services. Just like income from sale of securities will not be included as income from the sale of bonds, shares, debentures will not be calculated as these transactions do not contribute to the current flow of goods and services. These financial assets are just paper claims and include the transfer of title only. However, any kind of commissions or brokerages on such asset is included in national income as it is a predictive service. With it, the windfall gains will not be included. Income that arises from windfall gains, like horse racing, lotteries, etc., are not calculated in the determinations of national income as they are connected with any kind of production activity. With it, imputed value of services by owners of productions units will not be included. The imputed value of self-occupied houses, production for self-consumptions, interest on owned capital, etc., are included under national income as these are productive activities and add to the current flow of goods and services of the economy. With it, the payment out of passing saving will not be included. Payment out of past savings such as interest, tax, gift, tax, tax duties, etc. is not calculated in the national income as they are paid out of passing saving or wealth and do not contribute to the current flow of the goods and services of the economy. Hope student, you well understood the income method of the national income. Now we discuss about the expenditure method. Expenditure method household or consumers expenditure on the consumption's goods, firms or producer expenditure on of capital goods also known as gross investment, government expenditures on goods and services excluded, um, transfer payment expenditure on export and import. So GNI, gross national income, is individual expenditure plus government expenditure. So, the expenditure method is a system for calculating gross domestic product (GDP) that combines consumption, investment, government spending, and net exports. It is the most common way to estimate GDP. It says everything that the private sector, including consumers and private firms, and government spends within the borders of a particular country must add up to the total value of all finished goods and services produced over a certain period of time. This method produces nominal GDP, which must then be adjusted for inflation to result in the real GDP. So the expenditure method may be contrasted with the income approach for the calculated GDP. The expenditure method, so we can say in the simple we can say the expenditure method is the most common way to calculating country's GDP. This method added up consumer spending, investment, government expenditure, and net export. Aggregate demand is equivalent to the expenditure equations for GDP in the long run. The alternative method to the calculate GDP is the income approach. So expenditure method is a reference to spending in economics. Another terms for consumer spending is demand. The total spending or demand in the economy is known as aggregate demand. This is why the GDP formula is actually the same as the formula for calculating aggregate demand. Because of this, aggregate demand and expenditure GDP must fall or rise tangent. So, the expenditure method is most widely used approach for estimating GDP, which is a measure of the country's output produced within a country's border, irrespective of who or owns the means of production. The GDP under this method is calculated by sum up of all the expenditure made on final goods and services. There are four main aggregate expenditure total go into calculating GDP. First of all, consumption by household, next investment by businesses, next government spending, on goods and services, and net export, which are equal to export minus imports of goods and services. So GDP is the formula of expenditure GDP is GDP is equal to C, consumer spending on goods, plus I, investor spending on businesses, plus G, government spending, plus X, export or minus F, import, yani net export. So main components of the expenditure method is the mostly uh, two is a consumer, sorry, consumptions, investment, government expenditure, and export and import. So in simple, we can say consumption expenditure is include household consumptions of goods and services. It also include government expenditure on goods and services to fulfill social welfare's needs. Investment expenditure refers to the expenditure made by companies and production units for raising capital. For example, investment expenditure includes the purchase of mixed capital assets such as building and equipment, and expenditure also includes on addition to the stock of raw material, and investment expenditure also includes as acquisition of valuables such as precious metals of jewelry, and expenditure also include imports and exports made by companies and the government. And while calculating national income, you need to calculate the net export. Net export annex thus is the total export minus total import. Now, while calculating national income using the expenditure approach, you need to also deduct depreciation on the capital assets and indirect taxes. Using the expenditure approach, national income can be represented as national income is equal to C, household consumption, as I also discuss you, plus G, government expenditure, plus I, investment expenditure, plus NX, net export. Again, while determining income using the expenditure approach, you need to exclude expenditure on the second-hand goods, purchase of shares and bonds, expenditure of transfer payment, unemployment benefit pensions, and purchases of intermediate products. So, student, I think you well know what is the expenditure method. As I also given here, measurement for the national income by expenditure method. National income is equal to national product is equal to national expenditure. You can say the expenditure method can determine national income during the disposition phase. The national income is calculated using the expenditure method as a flow of expenditure. The gross domestic product (GDP) is sum of the all private consumption expenditure. The factors such as government consumption expenditure, gross capital formations, public and private, and net export must be considered here. You can find out in total consumer expenditure 50,000, gross investment 20,000, government expenditure 18,500, export 9,000, import 8,565, change in stock 1,000, net income from abroad 250, expenditure taxes 870, subsidies 695, and capital consumption 2,750. I think student well understood the methods of the measure of national income. So, in this video, we also discuss the two methods, income methods and expenditure method. And in the previous video, we also discussed about the prediction method in value added method. Now, so it's the importance. Now we discuss the importance of national income. useful of measuring the standard of living of nation through estimating per capita income of the nation and time series comparison year to year. You can also find out measuring growth of the economy and comparison between two or more countries can be made useful in revealing the expenditure patterns of a country and useful in measuring the level and patterns of investment and is also useful balance of payment patterns national income as an indicator of success or failure of national planning. So, to compute the economic advantage of a country, to compare the economic growth of several countries, to measure the contribution of different sectors of the country's economic growth, and to analyze the issues experienced by the economy to assist the governments in planning, the uh, implementing various projects, and to determine the limitations and benefits of various economics activities like productions, consumptions, and distribution. So, national income is very important concept because it gives us an idea of how well the economy is doing. It also helps us to compare the standard of living between different countries. National income is usually measured in terms of GDP because it is most comprehensive measure of economic activity. National National income data is important for the economy of a country. In present times, the national income data are regarded as accounts of an economy, which are used and known as social accounting. It is tells us how the aggregates of nations' incomes, output, production result from the income of different individual production product of industries and transactions of international trade. With it, national income data forms the basis of the national policies such as employment policy, industrial policy, agriculture policy, etc. National income also helps to generate economic models like growth models, investment models, etc. Thus, proper measure can be adopted to bring the economy to the right path. With it, for economic planning, data pertaining to national income is very essential. It includes data related to our country's gross income, output shaving, and investment and consumption, which can be obtained from different sources. But national income is also used by research scholars of economics. They make use of various data of the country input, output, income, saving, consumption, investment, employment, etc., which are obtained from social account. With it, national income data help us to compare the standard of living of people in different countries as well as of people living in the same country at different times. With it, national income statistics enable us to understand the distribution income in the country from the data related to wages, rent, interest, and profit. So we understand the disparities in the income of different sector. So, student, in this video, we also discuss the methods of measuring the national income, expenditure method, income method, and expenditure, both sorry, value added method. And we also know the importance of the national income. So now, thank you very much.